Hello, everybody. This is Colin Casey, Wealth Advisor at Stonebridge Financial Partners, coming to you live with first quarter 2026 video notes and a little bit of information for you as we wrapped up 2025. One thing to note, in January this year, I've actually been partnered here with Stonebridge Financial Partners for 10 years. So I just want to express gratitude and being part of all of your lives and working with you and also being involved in the community. Personally, also, many of you know that my wife and I, we have a 9-month-old daughter. She recently just started walking, which is pretty cool. As many of you have noticed, it's very cold outside, so I do have some tidbits for you on some of my favorite things to do just to get some reprieve. Number one, you could check out the Belle Isle Conservatory. It is free to get onto Belle Isle as long as you have the P Pass, the Michigan State Pass. The Detroit Zoo has an excellent butterfly garden. It's very warm in there. The Detroit Institute of Arts Atrium is a really nice outdoor feeling place. It's free for Wayne, Oakland, and Macomb County residents. And believe it or not, my wife and I, we've been doing a little bit of mall walking just to get out of the house and to take our daughter to go do stuff. So hopefully that helps, and maybe you can check some of those things out. Shifting over to economic things, just a report on U.S. stocks to start. U.S. stocks across the board had positive performance last year, along with strong earnings. Earnings are expected to continue as companies expand investing in AI in their businesses. There's a study out there, the IBM CEO study, and 52% of 2,000 CEOs say that they plan to implement AI in their companies to reduce costs. Looking ahead, 85% of them expect that scaled AI investments in their businesses will deliver positive returns by 2027. AI requires physical infrastructure and energy. This presents investment opportunity all around the country. In the 2025 One Big Beautiful Bill passed offers U.S. companies tax credits and incentives to invest in their companies for U.S. manufacturing. All these things present investment opportunities, if you will, looking forward. Internationally, after years of underperformance, international developed and emerging markets experienced positive performance in 2025, and continued growth is forecasted. Bonds had strong performance in 2025, with established higher yields and Fed cuts. This attributed to price appreciation, which has been nice to see in portfolios. There are less rate cuts forecasted for this year. Bonds are expected to produce income still, but we think there will be less opportunity for price appreciation. Inflation is reported to be 2.7%, which is well below post-COVID recovery inflationary times, but this is still above the 2% Fed target. Unemployment did rise last year to 4.4% from 4%. Unemployment is expected to hold steady in 2026. The Fed will be monitoring this closely. If unemployment rates do rise, that increases probability for more rate cuts. With inflationary pressures persistent and continued Treasury issuance driven by large federal deficits, we expect the Fed to have limited ability to reduce long-term rates, meaning that mortgage rates reasonably will remain elevated that we've been experiencing recently. Central banks have cut money market rates. So in your high yield accounts, you've experienced a peak of about 5.33% yield going back to September 2024, and now rates are approximately at 3.64%. This means that monitoring cash positions prudently is definitely important. Unknowns for the upcoming, at least for what we can see right now, would be things like the Supreme Court ruling on tariffs and what that impact looks like. Geopolitical conflicts, of course, the continued Russia-Ukraine war. Who knows if other conflicts will arise. Things like Venezuela or stuff going on with Greenland. There's a potential change with the Fed chair. So what does that leadership change mean, and how will that impact markets and the overall Fed direction? What we do know is that the stock market and markets in general have done well over the last 3 years. So you definitely, and as we've been doing with our clients, check in with your advisor for your financial plan and how things are going. Right now, definitely, it's time to look at portfolio rebalancing and de-risking. Pay close attention to cash flow income based forecasting and resetting, again, to de-risk and just make sure forward looking that you can navigate whatever comes our way. As always, you want to think about maximizing tax brackets and thresholds, but certainly we cannot predict the future with a crystal ball, so checking in on financial plans is the most important takeaway, as always. If you have any questions, please reach out to me. It's good to be with you all, and stay warm out there. God bless.